Let's have a look at deceased estates. Remember, deceased estate is only for level 2 students. When we're looking at the estate duty framework, we need to remember we're using the Estate Duty Act. We will start by including property, so that would be houses, cars, paintings, assets of the deceased. To that we will add deemed property. Deemed property could be lump sums, insurance proceeds. From that we will deduct any deductions in terms of Section 4 of the Estate Duty Act. So this could be where assets have been bequeathed to the surviving spouse, master's fees and executor's fees, which you must know how to calculate, as well as any tax liabilities and other deductions relevant to the estate. That will result in the net value of the estate. From the net value of the estate, each deceased estate is entitled to a maximum abatement of 3.5 million. Just remember that if the person that is deceased had a previous spouse that was deceased before them and they did not use the full 3.5 million abatement, then whatever they didn't use can be added to the, in essence, second spouse that passed away's abatement and reduce their estate that way. Once we've applied the 3.5 million abatement, if there's anything less, estate duty is levied. When we are dealing with estates, you do not need to know how to calculate the value of a usufruct. We will give you the value of the usufruct. You just must know that you must either include it or not include it, depending on the information that is given in the question as part of property. A change that came into effect on 1 January 2018 is that the master's fees in deceased estates has changed quite substantially. So make sure that you know how to calculate the master's fees when we're dealing with a deceased estate. If we have a look at the effect of capital gains tax on an estate, where we have the deceased, remember when somebody is deceased, their year of assessment ends on the date of their passing. For capital gains tax purposes, that person, the deceased person, is deemed to have disposed of all of their assets the day before they passed away, except for assets that are bequeathed to the spouse or to public benefit organizations. Long-term insurance policies and lump sums. If we have an asset in the deceased estate, an office block, which cost them, in terms of a base cost of 3 million, at the date that the person passed away, we need to know what the proceeds are, and they will be deemed to have disposed of them for an amount equal to market value. Therefore, in this person's last tax return, they would have a capital gain of 2 million on this asset, as they were deemed to have disposed of it. Once the deceased's tax year ends, the deceased estate in essence begins. The transfer of the assets into the deceased estate are transferred at the market value at the date of the death of the deceased. Therefore, the market value that went into the deceased's, let's say, final tax return will become the base cost of that asset in the estate. Once the estate transfers this asset to the beneficiaries, the beneficiaries will have a base cost of whatever it went into the deceased estate at. It could create a capital gain in the deceased estate if the deceased estate were to dispose of this asset in order to, let's say, settle liabilities or pay out beneficiaries. If the market value had increased from what it was at the date of the death of the deceased, that capital gain would fall within the deceased estate. Where these transfers are made direct, the beneficiaries are deemed to have acquired that asset for the market value at the date of the death of the deceased. Thank you. That is the end of deceased estates. Make sure that you spend some time working through the examples and the questions in your tutorial letter to familiarize yourself with the details of deceased estate.